Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Bronson Hill. Bronson is the founder and CEO of Bronson Equity, a multifamily investment company that's a general partner in over $200 million in performing real estate assets. He's also the host of the Mailbox Money Show podcast and author of Fire Yourself, Replacing Your Working Income with Passive Income in 3 years or less. In addition to his real estate business, he also operates an educational platform, hosts the Bronson Equity Monthly Investor Series, and co-leads a large monthly meetup in Pasadena, California for investors. Bronson has spoken personally with over 2,000 investors and is passionate about helping these busy professionals create passive income and grow cash flow through investing in alternative assets. Bronson, welcome to the show.
Hey, Marc, excited to be here today, man. I love talking about finance and being an agent of wealth, so I'm looking forward to it.
Great. Yeah, I'm looking forward to it too. I know in October 2023 this year, you published the book Fire Yourself, which offers a practical guide to achieving financial independence through passive investment in alternative assets. In the book, you share your personal journey, but I was hoping we could discuss a little bit of it here. How'd you go from leaving a high-paying corporate job to pursuing passive income opportunities?
Well, it's, I don't know, sometimes we look at our lives and we say, why did I make that choice or why did I do that? But, I had a job, I was making over $200K a year and I was doing medical device sales and I had it down to about 30, 35 hours a week. But the one thing I didn't really have is I didn't have control over my time. And I really love traveling. I love being able to create things like writing a book, or I'm a musician, so I write music, or, spend time with family. And it's just, I realized I wanted to have that flexibility to be able to structure the day how I wanted to. And I knew that, when I got older, if I was, in my 70s or 80s, I think, man, what if I didn't, what if I'd actually gone for it? What if I actually had not let fear or just comfort kind of taken place of being able to really go after my dreams. So I decided, it was interesting. My family was all like, hey, why would you ever leave your great job? Because they're all teachers and nonprofit and other things. And then I had I was in a part of an entrepreneurs group, and I met with 5 other entrepreneurs over a period of about a year or so. And they all, without exception, were like, you should leave your job pretty much as soon as possible. And they were like, it may not work, but you won't know until you try. So I think, to me, a lot of people, and this is my story, is, we say we want financial freedom, but really I wanted freedom over my time. And I feel like being able to leave, now we're recording this, 2023, the end of the year. And I just took my 6th international trip, was in New Zealand for 2.5 weeks. And to me that, financial freedom means time freedom. And so I'm sure for a lot of people you work with as well, it's, we'll say we want a certain thing, but really what we want often is we want to have the ability to make money without having to do a time for money trade. And so that's what it was, been really exciting for me to get out of the time for money trade business.
Was your success and the success that you've seen people have, was it based off of going cold turkey and quitting the job and going all in, or did you wean yourself into this passive income strategy?
Yeah, that's a good question. People ask, what's the right time to quit your job? When do you fire yourself? Do you do it? Some people are like, they have no money and they take out debt and they do a mentorship program in real estate. And they're like, I'm going to go do real estate. And then other people are like a month shy of retirement. And they're like, I quit my job. And you're like, yeah, we were a month away. So somewhere, between those two, obviously, hopefully is a happy medium. I basically, there's different numbers. A lot of times we think in terms of, if I'm making 100 or 200K a year, I've got to replace that before I can leave a job. I looked at it, the idea of a rat race number, right? Of how much do I need to live to cover my expenses, right? And that's kind of the first area of financial freedom. It's much more doable than the higher number. So for me, it was 60 or 70,000 a year. I thought, well, I don't live super fancy, cover my housing, cover my insurance, my car, some travel, food, things like that. So it was about 5,000 or 6,000 a month. So it wasn't a lot. And then I realized if I could get to that number where I was generating that type of income through my investments or through my passive activities, I would have the ability to leave the job, and everything else above that would just be kind of cake, on top of that. So I got to where I wasn't able initially to replace my income, but I got over time, I was able to do that. And so when I left, it was kind of like I had enough passive income to cover the rat race number or cover the expenses. And I was well on my way toward replacing my income.
You mentioned you had investments and they were generating passive income. There's obviously a lot of different types of asset classes that can produce passive income. When you started, what were the assets that you were utilizing and how has that transformed over time to some of the things that you utilize now?
It's interesting. What I started with was single family investing. And then I realized that was a lot of work and it just didn't produce the type of cash flow that I wanted. Because the challenge is, if you have 2 or 3 houses or whatever, a lot of times there's maybe a little bit of cash flow, maybe there's just kind of a break even. But I tell people, if you really want to get to where you can scale your wealth, if you can't 10x the size of what you're doing, so if you have 3 houses to go to 30 houses, that's a lot of work. That becomes another job, right? So I didn't want another job. So I started looking into larger deals, larger multifamily deals. So the first kind of larger deal that I did after doing the single family was 225 units in Texas. And again, my role in that was just simply raising $100,000 from one investor I met at a meetup that I had started, the same meetup that I lead now, but the meetup I'd started in the LA area. And over time, just being able to kind of create that for people, real estate is a great way to do it. I think these deals they're called syndication deals or syndicated deals where there's no investment that's fully passive, but it's more passive. So what you do is you vet a deal, you vet a team that's operating it, see their experience, their track record, things like that. I talk about it in my book, how you vet any deal, whatever asset it's in. And then over time, you can scale it up. So once I kind of got used to that, then I started raising more money for different deals. I started investing more of my own money in other deals as well. And that was really how I was able to leave my job. Now it's shifted a bit. The last couple of years, interest rates have gone from 3-4% to often 7-8%. And so we've done a lot more stuff that's cash flowing type of businesses. So we have the 4th largest operator of ATMs in the country, ATM machines in the country. We're working with them, working with a group that does car washes, oil and gas deals. We also have some other stuff in real estate that's more either development or other types of projects. So just trying to find things that, really have cash flow. And I think that's, people ask, would you rather make a lot of money one day with a deal like a big appreciation deal, or would you rather have cash flow, which is more important? And I'm of the opinion cash flow is by far more important because that's really how you can leave a job. That's how you can cover expenses. That's how you can get to where, a lot of money someday isn't as helpful as I've got, $1,000 or $2,000 a month from a deal that's paying me every single month or every quarter. That's stuff that you can really use to be able to cover your lifestyle.
Yeah, I want to unpack a couple of things there. The first is, you mentioned single families, and a lot of people do get started in single families, and sometimes it's even accidentally where they own like a condo or single family, and then they move and they don't sell, and that becomes their first investment. But can you explain the difference in terms of scaling, or why it's difficult to scale a single family versus a multifamily type of investment?
Yeah. So again, I'm not fully against single family. I do think some people do very well. It typically takes at least 10 to 15 years to really do well with single family, just because the appreciation can take quite a bit of time. And it's really an appreciation play. So again, it's making money, when you sell or at the sale, and over time, maybe cash flow will grow. But if you look at actually how much cash goes into a deal, you have a figure called a cash on cash return, which basically just means, how much money did I put into this? Did I put 100,000 or 200,000 in this? Well, what is that return actually generating per year? And these days, it's really hard to find anything that really even breaks even with cash flow. A lot of times you're subsidizing. And I think that one of the reasons I've kind of wrestled with that is why do most investors think of real estate and we think of single family? It's because most of us have lived in a house or live in a house and we think, oh, I know this. If I get another house, I could just rent this out and whatever else. But the challenge with scaling is that, again, it really becomes a full-time job, and it's a very inefficient asset. Meaning, let's say if you have 100 single-family houses in a certain city, that's a bear of a work to try to manage, right? You've got to have a maintenance guy at $40-50 an hour or more go around and to go to one property to go see what the issue is, then go back to Home Depot, go get the part, then go back to that property and fix whatever the thing is. That's like a half day or full day thing. Versus if you have a 100-unit apartment complex, it's one roof, it's one set of plumbing. Typically, you get a discount on the labor because the maintenance people, you at least one, there's multiple, they work at the property, so they're there. And you have typically the same appliances, the same color paint. You have all this stuff, so it's much, much more efficient. And then it just really lends to have a much more scalable way of going. If I have 100 houses, again, a property manager has to try to manage all that and just kind of have a way to figure all that out versus 100 units, you can have a full-time property manager dedicated just to that one property, and they're on site all the time. So again, they get to know the property, they get to know the staff. It's much more efficient. And then as an investor, again, 100 houses, that it is literally a full-time job to manage that, even with a property manager. They're going to ask you, hey, what do we do in this situation here? What do we do with the toilet? The tenant's not paying, whatever. And if you want a lot of headaches, just go buy a bunch of single family houses. But if you get an apartment building, there's standard processes there. It's like, here's what we do when people don't pay. Here's what happens. And we work this, and it's not going to hurt you. If one or two are vacant or things happen, you're going to be able to very efficiently manage it. So when it comes to scaling, the larger properties just tend to be, you get better management. It's much cheaper for the labor. It's cheaper to run it. They actually cash flow better, and it's much easier to scale.
Do you recommend when someone starts out that, because you mentioned your path, where you quickly got to if it was 100 or 200 unit, that's probably difficult for a lot of people to do, to go directly to that one from, if they're going to do it passive, if they're going to be kind of a limited partner in it, they're in a syndication, they have to have the money to do it. Or no one's really going to go out and their first property they buy is going to be a 200 unit multifamily property. Do you see people starting out in the single family route because it's something that they can get some experience, they can make some mistakes, they can learn, and then they move? Or I know you mentioned you were raising funds for that syndication, and maybe that's a way that people get started. Or do you just recommend, no, you have to have some kind of pile of money on the side to get started in this?
Yeah, so there's really two paths to go. Either you have time or you have money. To me, I didn't really have either. I had a full-time job and I had a little bit of time. So I leveraged my time, and then I put the money I was making, I kind of put it into deals. I didn't have hundreds of thousands or millions of dollars to put into a deal. There are people that have, over $1 million that, are just kind of like, hey, I want to put some money in a deal. To put 50 or 100,000 in a deal passively, $100,000 is a lot of money, but it's not, half of your net worth or something. So you could put that in a deal. How that I talk in my book of a process of how you vet different deals of different asset classes. So whether it's multifamily or it's ATMs or car washes or whatever, there's all kinds of stuff that's very interesting. So if people have more money than they have time, I would say try to become passive and put some money, $50,000 or $100,000 in one deal. You look at maybe 5 or 10 deals and then choose one, and likely it'll go okay, and you'll learn a bunch. And again, the biggest investment I think we make is in our own education, and you'll learn, oh, I like this asset. I don't like this asset. I like this operator. I don't like this operator. And then as you network with other passive investors, through meetups, through conferences, that's why we do a lot of events, is because you meet amazing people when you do that, and they'll share, hey, I worked with these guys, I like them, or hey, avoid these guys. They'll tell you kind of what they think about the groups, and that's very helpful. So if you have more money than you have time, do that. If you have more time than you have money, you can do what I did, which is learn how to approach it either of raising money, which is what I did. I've raised about 40 million now for different deals, or you can basically find deals. So there are people that find deals. They find real estate deals, and they can basically bring those to investors. They can bring those to other people that are experienced operators of deals, and you basically get a piece of the deal. So the team that's operating, whether raising money, operating a deal, or finding a deal, they'll typically share on the upside. So that's how I was able to 20x my net worth to 7 figures in about 3 or 4 years, right? It just came from being able to try to find a way to bring value to people. So I think there's different ways to enter it, and some people are not one or the other. It's both. You can. I will say avoiding single family I think is good, because I think it's just harder to scale. And so you can spend 5-10 years doing it and then realize, oh man, I wish I'd moved to multifamily. I actually have a cousin who kind of got me started in multifamily, and he said, everybody he knows in multifamily investing says, man, I wish I had started investing in multifamily sooner. So I don't really think you need single family experience to go into multifamily, but some people feel like they want to, they can. It's just, again, it's a mindset. We think, oh, I have to do this because I know single family investing, but I do think the larger stuff is much better.
I want to go back to the cash flow versus appreciation topic that you were talking about. Now, we both live on the coast. I'm on the East Coast, close to New York City. You're on the West Coast, close to Los Angeles. It's definitely hard, probably in our areas, to find cash flowing properties. But with the changes over the past couple of years with interest rates going up, is that still what it used to be was, oh, go to the Midwest or the Rust Belt or the South or different areas, and there you can find, maybe they won't appreciate as much, but you'll find cash flowing properties. Are you still seeing cash flowing properties in those areas? And do you invest, geographically outside of LA?
Yeah, so we don't actually invest anything in California. California is a not very landlord-friendly area. There's tax issues, there's business issues, there's lots of issues. So we actually, mostly Florida, Georgia, Alabama, those kind of Sun Belt areas is kind of where we invest. I think in general, right now it is an interesting time with rates increasing. They say, at least from single family, it's the least affordable time in the last 50 years to buy a house because interest rates have come up to where the payment now is getting to be it's unaffordable. But then people that have homes don't want to sell them, right? Because they've got this 3 or 4% or 2.5% rate, and so the asset really is the loan. So if somebody has a really low interest loan, they can have that and just hold that, and it will serve them very well for a long period of time. So it's interesting time. I do think we are, especially in multifamily, we are starting to see some really good deals come available now, where groups that are having trouble with valuations, or there's examples of people paying much more, and all of a sudden now the rates are higher. So the issue is buyers cannot afford to pay these lofty prices because the rates that they're being quoted are they're not even able to cash flow some of these big multifamily deals, and so that does significantly devalue the value of the asset. But the interesting thing on that is that right now it is interesting for investors because a lot of investors are not interested in investing in multifamily deals. So it's kind of this Warren Buffett principle, right? Be fearful when others are greedy and be greedy when others are fearful. There's some fear out there right now, right? So a lot of people that were interested in multifamily, maybe some of their deals have had some trouble, or there's been some issues with just the valuations now of deals trying to get refinanced or things that are out there. So the last couple of years, we've actually shifted a bit to do less real estate, less multifamily, and go to some of these other assets, such as ATMs, car washes, oil and gas, other types of almost private equity type of things, because these are cash flowing businesses. So I think that, it really depends what your goals are, and it depends on the specific deal and the operator. And there's a process I talk through in my book, Fire Yourself, about how do you vet a deal, and, looking at people's experience and their track record and things like that. And just, the specific asset itself. Do you understand it? Warren Buffett says we only invest in things that we understand. If you don't understand it, don't invest in it, right? So I think there's a lot of different aspects there. So there will be deals in every market if you're willing to look, if you're willing to be patient. But I'm also the one of, hey, if this asset doesn't look attractive right now, be open to other assets.
Yeah, it's interesting. Let's take a car wash as an example. Let's say you're looking at a multifamily real estate property, you look at a pro forma, different things that you analyze and make that decision on whether to invest in or not. Is a car wash a similar thing? You find one that maybe the owner's looking to sell and kind of evaluate it and then make that decision. And then how do you operate it after that?
So yeah, the car wash deal that we've done, the deals we've done in car washes have been interesting. The strategy is called a private equity roll-up strategy. This exists in dental practices and gas stations and car washes. That if you have 1 to 10 of gas stations or car wash, you have let's say you have 5 locations. It will sell for a certain multiple. It might sell for 8 to 10 times EBITDA or 8 to 10 times earnings. But if you have 50 of them that are very similar, it'll sell for sometimes 15 to 25 times earnings, right? So you have basically, it's valued twice as highly simply because you have more together. And you think, well, why is that? It's because private equity wants to buy. They don't want to spend $5 million for one car wash. They want to spend $500 million and buy 50 of them. They want to buy a bunch of them, right? So that's kind of how we approach. And my math is probably a little off there, but so what we do is this car wash deal we've done. We've worked with a large car wash franchise where there's 150 locations. They've never had one fail. It's very profitable, one of the most profitable franchises of any type. And we'll go in and we'll basically start building out new locations. And the goal is to sell within a few years. We're going to sell 50 of these to a larger private equity group that will pay a higher multiple. So, for investors, they will get cash flow along the way of owning this investment. At the sale, they'll get a premium on what these would normally be valued separately. So it's harder to do just with I've got 50 random car washes in one market or all over the country versus if I've got 50 car washes of the same franchise that are kind of run the same way, that have the similar financial metrics, and there's a group that can come in and buy this. It's a very scalable model that whoever buys it could continue to come in and say, we're going to double the size of this over the next 3 to 5 years and put in more locations, and they're able to kind of just take it and run with it. So that's really, the private equity roll-up strategy is it's a cash flow model, plus it's the appreciation of the sale. And we like that for a number of reasons.
We talked a little bit about how interest rates have impacted real estate. How has it impacted some of these other asset classes or these other types of businesses?
Well, it depends if it's a business that really relies on financing. Car washes a little bit does, so it affects a little bit because there's some financing that goes into buying land or to finance some of the construction, things like that. So it does affect it. I wouldn't say it's huge, but it does affect it. The ATM machine deal fund that we're partnering on, that one is zero leverage, so it's a full cash deal in every way, so it doesn't really affect it at all. But, I think it depends on the business. It depends on if leverage is used to buy assets or if it's just something that we don't really dependent on any interest rates.
What are some of the biggest mistakes you see investors get, whether it's multifamily or some of these other businesses, once they, when they get started, and maybe some that they make even as they, they're more experienced in it?
Yeah, so I think the biggest one, most people make when they get started is just analysis paralysis. There's so many things out there you could do, so many things you could invest. Multifamily sounds great, or self-storage, or doing ATMs, or doing mobile home parks. There's just so many things out there, and you can kind of get overwhelmed just that there's all these shiny objects out there. So I think that's one of the issues, is just really picking a course and choosing it. Over time, when people do invest, I think just really spending time and trying to understand who the operator is, maybe talking with other investors that have worked with them. And regardless, you can do all the stuff right and stuff can still happen. But I think having some diversity is good. I think too much diversity is an issue. I know a guy that's invested passively in over 70 deals, which I think is too much, because then that's a full-time job, right? So if you're trying to fire yourself, if you're in 70 deals, that's like, oh my gosh, like welcome to another job, or welcome to nights and weekends every day. So I think, being invested in 5 to 10 different deals is probably enough for most people. And over time, people may need to increase their allocations. So instead of putting in the minimum, maybe they put a little more into deals as they go along. But, again, once you get to know a certain number of operators that are good operators that you've worked with, you had experience with, you like their approach, you like the communication and the performance, then, maybe you can say, I'm going to, between these 2-3 operators, I'm going to put more of my assets with these guys. And so I think those are things. But most people, I think, that are passive investors don't go to events. They don't go to meetups. They don't talk to other people. And one of the most transformational relationships I found for passive investors is just meeting other passive investors, because they don't have anything to sell anybody. Like for me, I'm a syndicator. We raise money for our funds. I know you are investment advisors. So we have products and things that we provide people with and help people. But we do have a bias where we want people to use our stuff because we believe in it, right? But a passive investor, another passive investor, they're just simply out there to help and learn and collaborate. And so it's a really great relationship, I find, for other passive investors, because this is somebody who has no financial interest at all in anything except just try to be there and learn and help other people, which is cool.
All right, well, we're just about out of time. Bronson, I'd like to thank you for joining us today. You provided some great info on passive income through multifamilies and all other alternative assets. How best can someone find out more about you and what you do?
Thanks for having me, Mark. This has been a lot of fun. So if people want to check out my book, it's on Amazon. It's Fire Yourself, and you can check that out there, or on my website, bronsonequity.com. You get the first couple chapters for free, so you can go. There's a free download there. We also have information about our investor clubs that people can check us out there. We're also on all the social medias, just Bronson Hill. You can check me out on social media.
Great. We'll link to all that in the show notes. Thanks again, Bronson, and thank you everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.